If you're interested in investing in real estate, this video is for you. If you've been subscribed to this channel for a very long time, you guys know that I'm very interested in real estate investing. So I'm showing you 4 ways here that you can get going into real estate investing, some of which is a lot easier, some of which is better, some of which is more difficult, some of which earns you more cash. I'm showing you the 4 ways here. We're going to start off with number 1 here, which is generally the probably best way to go if you are a control freak like me, which is it's just really simple. This is the one that everyone knows, and it's yourself. We're going to go over some of the pros and cons of each of these here. So yourself, some of the pros here. Some of the pros is you have full control. You have full control over everything you do. If you want to go out and buy property X, you go get property X. You can get the tenants. You can get whatever property management company you want. Now there's downsides to this. You have to put up all your own money. If you have bad credit, you might not be able to get a mortgage. It can be difficult to actually save up to buy a property that first time, actually, especially if you're a young person. It's a lot of areas you have to save up, let's see, 20% down payment, so that would be, roughly $40,000 to $50,000, which is a lot for people in their early to mid 20s. Your late 20s, you probably have some money saved up. So yourself is difficult. It's difficult to start going into real estate by yourself. And I've come to realize that because, I'm young and I'm making a really good amount of money right now, yet banks, because I also live in a really wealthy area in the world, I guess, it's real, all the properties around me are $1 to $2 million. And so I'm not there yet. I need to save up a little bit more. Next year, hopefully I can buy one of those places. But yeah, it can be really difficult to get started in real estate by yourself. But I think it has the highest upside. You get the most tax advantages too. We're going to talk a little bit more about that in a second here. We're going to move on to number 2. Number 2 way is, so this is REIT, which is essentially a stock. But a real estate investment trust is essentially a stock. So what you're doing is you're investing in a real estate company. And this is completely okay if you believe in real estate. You can invest in a real estate company that only does real estate in New York, or one that only does real estate in California, or one that only does one in Toronto, one that only owns 10 buildings, 10 apartment complexes, one that only, actually, you'd probably need to be registered. Yeah, about 10 apartment complexes, maybe a little bit more than that. And yeah, so you can invest in real estate companies. That's a solid way to invest in real estate. Now saying that, it's pretty much you're investing in a stock, because you're only going to get back a 6 to 10% return. You can cash out most of the time. It depends on the company, depends on where you're investing. But you can buy a tiny share of a real estate company through a real estate investment trust. But you'll get back, if you were to invest, usually the minimum is around $5,000 to $10,000. So let's call it $10,000. If you were to invest $10,000, you're essentially a shareholder in a real estate company, and you're going to get back 6% per year, which is $600. So you're pretty much investing in stocks. If you go through a REIT, the advantages of this is that you have to do zero work. You need zero intelligence. You put in zero work, pretty much no time either. So this is the lowest entry point. You really don't need much to get into a REIT if you really want to. And you can look up some good ones online, depending on your area that you want to invest in. So no time, no effort goes in here. A REIT. We're going to move on to number 3. This is really good if you want to get started, just with your first couple properties. This is called syndication. Syndication. And so this is also a partnership. And we're going to say partner. So syndication, it's you're pretty much going in with partners to buy a property. So if you have $30,000, your friend has $30,000, some other friend has $30,000, you each own 33% of this company. So if you're going to get into a syndication, you're going to want to set up a corporation, most likely, and divide the shares proportionally to how you want. So for this example, 3 partners, 3 people putting in an equal amount of time and effort, an equal amount of money, so they each own 33% of this corporation, 33.3%. And the advantages of this are, obviously, it's easy. You have more money available to you if your partners have money. Maybe they have skills that you don't. Maybe one of them's good at property management. One of them's good at fixing up the place. One of them's good at getting tenants. Maybe one of them is a real estate agent. Maybe one of them has more money. So partnerships can be good when you're just starting out. So you guys can buy a property together, share the returns, share the expenses, share everything. It's a good way to get started in real estate, is a syndication. But you don't get as many advantages as you would going in by yourself, but you also don't have as much risk, and it's easier to get started. Moving on to number 4 here, which is backfilling. Backfilling. Does anyone know what this is? This is a way for you to cash out on your real estate investments and still own the properties. All right, so this is it's something that I think Grant Cardone does this actually. And maybe the guys on Bigger Pockets do this sometimes too. Bigger Pockets podcast. I'm not sure though. I think one of them might do this. But what they do is originally they go in by themselves. So you buy an apartment complex, $10 million. You go in by yourself and you own the property, you get the mortgage, you get the financing, it's all on you. But then what happens is that after about 3 or 4 months, some investors see that this property is making a profit, it's doing really well, you guys fixed up the place, it looks really good. So some investors want to come in. They say, hey, can I come in for $1 million, but because the property's probably improved since you've owned it, they're going to come in $1 million and own 5% of it. Okay? And so, or maybe 7% or something like that. So they come in, they own a part of the property, and then you pay them a portion of the profits every single quarter, every month, every year, whatever they want. And so it's a way for you to own a property and cash out at the same time. It's like you're setting up your own stock company in a way. You're selling off shares to certain properties, but you're still the owner. It's like if you sell 49% of the property or whatever, you still own it. You still have full control, but you also cash out, it's really interesting. So I think Grant Cardone does this because he just wants free cash to use for other businesses and more deals. So it's a really rapid way to have a lot of money available to you. It's really cool, and you still get the tax advantages. So I guess we should talk about that too, about the real estate tax advantages, which I've talked about in previous videos. You can check them out. How to legally pay no taxes using real estate. So if you were to buy an apartment complex for $1 million, let's say, there's a lot of tax deductibles you can write off. So you can write off, there's this thing called depreciation. So if the building is worth $1 million, you can write off 3 to 4% of that building's value every single year. So for that building, it would be $30,000 to $40,000 as a tax deductible. So if you were to make a $40,000 a year profit on that $1 million building, you get zero tax. It's not taxable because you can write it off. Interesting, right? So there's other things too. You can write off the interest on the loan, all expenditures that go towards the building itself or to the land. All of it you can write off. What else can you write off? Expenses at getting tenants, property management companies, you can write that off. There's lots of expenses that you can write off, but the big one is depreciation and the interest on the loan. You can write those two off. So that's the big advantage. You can get major tax deductions if you go in by yourself. They still stay somewhat true to syndication, and they still stay true to backfilling. But if you go in for a REIT, you get no tax advantage. Unless you sell your stock, your share, for more than you bought it for, then you get the capital gains. That's about it. So those are the 4 different ways that you can invest in real estate. Which one do you want to start? Which one would be easiest for you? I mean, my original plan was syndication. I had some partners set up, and then I started making more money and realized that I'm willing to wait a year and go in by myself. So syndication, it's probably the easiest to start. Or a REIT is probably the easiest to get into, but it doesn't have a good return. Yeah, so which one? Which one's best for you? Leave a comment below. Is there any other way to invest in real estate? I know that there's flipping. Flipping is not investing. Flipping is speculating. Flipping is putting in work and time and effort, flipping and selling for $10,000. It's not good. All right, $10,000 profit. All right, I don't like that. Flipping is not investing. So get that out of your head. Yeah, is there other ways to invest in real estate? Let me know. Anyways, I'd like to thank you very much for watching. You're all very beautiful people, and I'll see you guys in the next video.